Okay, I believe that our usual technical issues, are now done, and we can get going. So, if we'd like to move to the first slide, please. This just covers the bits of news that I want to talk about this week. There's not actually an awful lot going on, but a couple of things just caught my eye. So, Aberdeen Asian Income and Pantheon Infrastructure. So, the first of those is Aberdeen Asian Income, and you can see the chart here on the screen. It's not particularly impressive, kind of quite flat over the years, but that's mainly down to what's been going on with China, which has obviously been depressing everything in Asia. Sorry. And then, as you can see here from the slide you've got here, which is the sort of snapshot of the Asian income funds, Aberdeen Asian Income Fund trades on the widest discount, about 11.5. And I think that's a bit undeserved. And I think I want you to remember the sort of Henderson Far East Income one underneath that, which is 3.25 premium. So if we look at the next slide, you can see that actually Henderson Far East Income has by far the worst performance of all four of these trusts. And Aberdeen Asian Income is a lot better than it. And the main difference between the two has been, until very recently, that Henderson Far East Income was on a far, far higher yield than Aberdeen Asian Income. And so, if we look at the next slide, what they are proposing to do is to introduce an enhanced dividend policy. And this one is really quite punchy. So, the most we've seen so far, when we come on to a minute, is 6%. This is 6.25, so that's what they're going to pay out every year as a percentage of NAV. And they're going to have a continuation vote every 3 years, starting from June 2028 as well. So to give you a bit more detail on this, what they're going to do is pay out, as it says there, a percentage of the NAV at the end of each quarter. So for March, the end of March, they'll look at their NAV at the end of December and take 1.5625% of that and distribute that as a dividend. And part of that will come from the natural portfolio income, but some of that will have to be made up from distributed reserves, so from the capital performance that they've had previously and will have ongoing. So based on the NAV at the moment, that would imply a dividend in May of about 4p, which would be the dividend for the end of March quarter. But before we get there, there's an extra large dividend coming up in February of 6.78p. So there's actually quite a lot of income to come out of this in the next few months. And I think this might help drive that discount down a bit. It was working its way up to being a dividend hero, so 16 years of consecutive dividend growth. It's important to remember with these sorts of structures that you're not guaranteed to get that growing dividend in the future, because obviously if the NAV goes down, the dividend will go down. So that's worth bearing in mind, but you are getting obviously a much higher base level of income anyway. They're not changing what they're doing within the underlying portfolio, so there's no change to the way they manage the money. So obviously how the portfolio performs is going to make quite a big difference to this. And if they had a long run of not generating 6.25% as a total return on the portfolio, then that would eat the NAV. But obviously they not think this is going to happen. So if we look at the next page, I wanted to mention Montanaro UK because we didn't talk about it in December, and that actually announced a similar kind of idea on the 6th of December. So it is paying out 1.6% of NAV to make 6% annually. I think it should be 1.5 rather, 1.6. Apologies. To make 6% annually. And at the same time, they actually changed the way they calculate the fees. It was quite interesting, I think. If you look at the chart on the next page, the discount did narrow. So you can see in that red circle a big sort of jump in the share price there. So I do think these things do work. Unfortunately, we've had a period in the last few weeks where we've had much higher rising bond yields. We've seen all about it in the papers, and this has obviously been depressing things. So that has meant the discount has very slightly widened out again, and the NAV and the share price have both come off. I think both of those things will be reversed in the next few months anyway. But it did seem to work for Montanaro UK. I do think it will work for Aberdeen Asian Income, but it seems that it's not an instant reaction. It may just take time. probably doesn't help that Morningstar's got the wrong yield on our website. We're going to email them today and get that changed. So that's that one. Now if we look at the next one, Pantheon Infrastructure, I love this fund. It just sort of keeps churning out the results. You can see the NAV just like climb. But obviously, along with all the other infrastructure funds, it went out to a discount when interest rates started going up. And you can see that there with the share price sliding for no good reason. But there has been an improvement in that since really about sort of 10 months ago. It's been sort of steadily rising. The discount's been closing. I think that should keep going. Big chunk of the issue with this one, well, not an issue really, it doesn't pay as high a dividend yield as some of the other funds in the sector, about 4.5%, because it's much more like 3i infrastructure than something like HICL or international public partnerships. It's about the total return, and it's got some quite decent numbers. So if we look at the next slide, there you can see it against the sector as a whole. So decent size, 434 million, but there's still one of the sort of smaller ones in the pack. And the discount is way too wide, but actually within this peer group towards the lower end, which is where it should be given the returns. And you can see that what I was saying about the yield there, 4.54. And then if we look at the next one, you can see that its returns are actually pretty good. And it's obviously not been going that long, so we haven't got 5-year numbers yet, and the 3-year numbers are held back a bit because obviously it takes time to invest the money and takes time for that to start generating NAV growth, but that is coming through now. And one of the ways it's coming through is with a disposal that's not reflected in that NAV return number there, that 10.91, that I think would catapult its returns back up towards where Cordiant Digital's are. So if we look at what they've done, on the 13th of January they said that Constellation Energy was buying Calpine. So Calpine was Pantheon Infrastructure's largest investment, and it's the first time they've actually sold something. Obviously they've not been going that long, so you wouldn't expect them to have sold anything yet. And actually even this is sort of coming quite quickly. It's not a clean exit yet, so about a quarter of it's coming in cash, 75% is coming in Constellation Energy shares. Those shares may be locked up for a bit, but anyway, the whole thing is going to take about a year to complete. It values the whole company about $16.4 billion. We're not sure yet what's going to happen to the cash. If you look on the next page, we wrote about it in the last Pantheon Infrastructure note we published in November, so if you want to find out more about Calpine, it's all in there. It's really quite a chunky business, but with all of these things that Pantheon Infrastructure is doing, it's not buying whole companies by itself. It's investing alongside a manager that it likes and it's done a lot of due diligence on and is comfortable with. And so Energy Capital Partners, ECP, led on this deal, and it's the one that's sort of calling the shots, if you like. And it's a really big US generation company. 27 gigawatts is a huge chunk of generating capacity, with a sort of bias to greener technology. So geothermal and solar, obviously, and battery storage, all that green agenda. Natural gas plants are a bit more efficient than coal, which is obviously good. But what they were trying to do was install carbon capture schemes, which were sort of partly funded by subsidies. So obviously we're not quite sure those subsidies are going to still be there with Trump in power, but it doesn't really matter anymore because this deal is done. So if we look on the next slide, these are the numbers. So that they said they were going to invest 58 million. I think they actually invested 54. It's the pound numbers you want to look at. So 46 million pounds was what they put into it. It was already valued at 56 by end of December 2023. And I think this exit values it at about 90.8. So they've almost doubled their money, which is pretty good going in a couple of years. And this last uplift, the extra 14 million odd, adds about 3p per share to the NAV. So all good stuff, and a big tick in the box for this company and what it's trying to do. And I think that discount should come down further over time. So that's that one. just very quickly before I hand over to Gary, we've been pushing on Saba. There's more stuff coming out. There's a very good article that we're about to publish on the website by Cherry Renard, and I encourage you to read that. David put up an article yesterday about voting, and I've just taken a snapshot from that. This is the Baillie Gifford US Growth one. Do please make sure you vote as early as you can, because some of these platforms cut off the voting quite quickly, quite way before when the meeting is going to happen. The Herald meeting's on the 22nd. I think it's probably already too late to vote on that one if you haven't done it already. So please, I hope you did do that. We'll know what the result is by the time I see you next week. But for Baillie Gifford US Growth, it's one of the next ones after that, and you can see what the dates are for the cut-offs on here. And that's our best estimate. This is not a guarantee, which is why I'm saying to you, don't rely on us. Go in there and get it done now. So, thanks very much, and let's now talk to Gary. There we go. Good morning.
Good morning, James.
Thank you very much indeed for doing this. We're going to follow the kind of usual kind of structure. I think there'll be quite a lot of questions about Saba and stuff as we go. But what I'm going to let you do, as usual, is sort of talk through the investment case for the fund first. So I'm going to hand over to you.
Great, thank you. If we could just skip forward onto the slide. Yeah, that's great. So if there's just one takeaway from today, it's this: please vote your shares. As many of you know, a US activist hedge fund is called the general meeting in an attempt to replace the board and ultimately the manager of US Growth Trust. And such a drastic move would fundamentally change the trust's mandate, which is why it's crucial that every shareholder has a say in this. I'm not here to tell you how to vote, but it's important to note that our independent board doesn't believe that the hedge fund's proposal serves shareholders' best interests. Their stance is that the trust is differentiated, they believe it's delivered on its mandate, and they think it's got a bright future. So there seems to be no reason to disrupt the compounding process that's nearly tripled shareholders' money since we launched this vehicle back in 2018. So please make your voice heard, and please do it now. As James said, the official deadline's noon on the 30th of January, but the platform's deadlines are before this. And if you don't vote soon, you might not get the chance. So please get on and vote. Next slide. So that's enough on the requisitioned meeting for now. I'm sure we'll come back to it in the Q&A, but what I wanted to do for the rest of the presentation was really cover 3 key points. The first point I'm going to cover is what makes Baillie Gifford different and why might you want to trust us with your money. The second point I'm going to cover is why we're excited about the US market after its strong performance over the last decade. I think this is a question on a lot of people's minds. And then the third point I'm going to cover is the rationale behind the US Growth Trust, why it exists, why it's important, and why it's attractive for investors. So starting with Baillie Gifford. Baillie, can we stick with the previous slide, please? Yep, so starting with Baillie Gifford. Baillie Gifford's a 117-year-old investment partnership. We've been doing this for a while. We've been managing investment trusts for a long time too. So our largest investment trust has been continuously managed by the firm for 116 of our 117 years of existence. And if I was to boil down what it is that makes us different, it's our time horizon. We're patient long-term investors and we look 5 to 10 years out. In contrast, a lot of the market participants today are looking to make quick gains. They're trading on horizons of months or quarters. And because we're playing this long game, we gain a competitive advantage on the back of that. We can buy great companies and then stick with them through the inevitable ups and downs, capturing the rewards from the big winners that go on to power market returns. And some historic examples of companies that we've invested in successfully following this approach have been the likes of Amazon, NVIDIA, Tesla. We've held all of these companies in our portfolios for years, but they weren't always obvious as winners. It was our long-term approach and our patience that allowed us to look through the short-term volatility in these stocks and hold on to these great companies for the benefit of our shareholders. Long-term investing sounds simple in theory, but it's actually very tough in practice, and that's why not many firms really do it. You need a business culture and a client base that's willing to look through the short term. We've been really fortunate at Baillie Gifford to have been backed by some incredible clients, like many of you over the years, who share our long-term perspective. Another key source of advantage for us is our partnership structure. So we're owned by 58 partners who work in the firm. We don't have any outside shareholders, and that means we're free from the sorts of short-term pressures that a lot of public companies come under, like quarterly earnings reporting, or activists popping up on their registers looking to make a quick buck. As the long-term owners of the company, I'm one of the partners in the firm. I've been with Baillie Gifford for 22 years, and we run the company for the long haul, and that philosophy naturally extends to our portfolios. Next slide. But let's focus on the US Growth Trust specifically. It's a large, London-listed, closed-ended fund that invests in America's exceptional growth companies across both public and private markets. It can invest up to 50% of its assets into private companies. And today we have just over a third of the company's assets in private companies. Next slide. So when you buy into this trust, you're not just getting the well-known public names like Amazon, Netflix, and Tesla. You're also accessing some of the best private American growth companies like SpaceX and Stripe. And really importantly, we offer this proposition at a low cost. I'll dive deeper into some of these points on the trust shortly, but first I wanted to address a question that I think is probably on many people's minds, and that's why invest in the US now after such a strong run over the past decade? I think it's a fair question, but I'm personally still very optimistic. The US has performed well for an important reason. It's been the single best hunting ground historically for exceptional growth companies, and its contribution to the global innovation economy has been unmatched. There's no other country that even comes close. Think of the most important companies in the world today. Almost all of them are American, and if anything, it feels like the US is pulling further ahead. And on the next slide, here's a very striking illustration of this from Andrew McAfee's Substack. It shows the number of companies under 50 years old with a market cap of above $10 billion. So it's a measure of the sort of vitality of these markets. On the left, you have US companies. On the right, you have companies in the EU. So what this very obviously shows us is that the US has produced a lot of big and important companies, and the EU has produced hardly any. On the next slide, this drives the point home even further. So what this slide shows is the share price performance and earnings growth for the US market at the top, and the share price performance and earnings growth for the rest of the world at the bottom. And what you can see from this is that the reason why the US market has gone up a lot is because US earnings have gone up a lot. And the reason why the rest of the world has gone up less is because rest of the world earnings have gone up less. In other words, the US has performed well because that's where the growth has been. And the reason why we're excited about the US today is because we don't see this trend ending. The US has been dominant and has grown so much because it's produced all of these great innovative companies. And when we look forward and we look at the technology waves that are coming through now, waves like AI, potentially longer term like quantum computing, the US is just as dominant, maybe even more dominant in these technology domains than it was in previous technology domains like mobile and internet. So we think that's very exciting and represents a very fertile hunting ground for growth investors. Next slide. So we've seen that the US is an incredibly innovative market. However, not all of the innovation in the US is happening in public markets. Many of the breakthroughs in important sectors like space and AI are being led by public companies. And this is becoming increasingly important because companies have been staying private for longer. So over the last about 25 years, the average age of a company at IPO has nearly doubled. And what that means is that today there are businesses that would have been public back then, but which are still private and which are sitting on huge valuations in the tens or the hundreds of billions of dollars. And that value creation has accrued to those private market investors. So To capture the full breadth of US innovation, you need exposure not only to the public companies that you can buy on stock exchanges, but also private companies. And gaining access to private companies isn't that easy. I mean, it's relatively straightforward if you're a big foundation or if you're a wealthy individual with connections into the top tier VCs, but it's much harder for the average investor. And this is why we launched the US Growth Trust back in 2018. It was about giving all investors, retail included, access to both outstanding public American companies and outstanding private American companies. Now, gaining access to private companies isn't straightforward. The best of them get to choose their shareholders. But because Baillie Gifford has built such a strong reputation over our very long history as a genuine long-term patient investor in innovative businesses, we can gain access to these companies. And there are very few investors that can say that. There are very few investors that have the sort of access to private companies that we have. Another important point to make is that you can't just own private companies in any size, in any vehicle. So open-ended funds can easily get into liquidity issues when they hold illiquid instruments, given that investors can freely redeem their shares. So investors taking the money away, you can't sell the illiquid stuff and it grows bigger and people start to worry about that. So we wanted a closed-ended permanent pool of capital because we think that's the appropriate type of structure from which to invest in these illiquid private instruments alongside public holdings. So the US Growth Trust is really the embodiment of this idea. Next slide. Just going to skip over, I think, in the interest of time. It shows our public companies are forecast to grow faster than the index. So next, please. Yeah. What I wanted to do is make another important point on why this offering, why the US Growth Trust is really differentiated. There are two key elements that you need to democratize access to private companies. Now, this is a real crisis, a real problem that needs to be solved for investors. One key unlock is giving the average investor a way to access these companies. But the second piece of this, and it's just as important, is ensuring that investors can access these businesses, private companies, cost effectively. So as many of you are aware, a lot of VCs charge the so-called 2 in 20 fee structure, which is a sort of 2% management fee and then a 20% performance fee. And we personally think that's very steep. So the ongoing charges for the Baillie Gifford US Growth Trust are 0.7%. And that ranks us second best out of over 300 investment trusts. And we don't charge a performance fee. And you've got to remember, over one third of this portfolio is in private companies. So we think that fee represents really good value. Just to give you a bit more perspective on that, there's a US closed-ended fund called the Destiny 100 that invests entirely in private companies. It holds SpaceX in size and it has a few other names in its private company list that overlap with the private companies that we own. It charges a 2.5% management fee versus our 0.7% ongoing charges figure. But even more strikingly than that, this vehicle, as you know, like investment trusts can trade on premiums or discounts to NAV. This vehicle is trading on, when I last checked, around about 1,000% premium to net asset value. So that eye-popping premium suggests there's real scarcity value in private market access. It's being recognized more right now in the US than in the UK. And it's very interesting in the context of the 7% discount that USA is sitting on. Let's look at performance on the next slide. So from the inception of the trust in 2018 to the end of last year, the trust return is 184% in NAV terms. So an investment in IPO has almost tripled. Now we're roughly in line with the S&P 500 over that stretch, a little bit behind. Obviously our aim is to outperform, but it's been a very challenging era for active managers to beat the S&P given its concentration in mega cap winners. That sort of return from the S&P over 8 years is not normal looking back over history. And the return that we've delivered actually puts us in the top 12% of global US equity peers. So roughly in line with the S&P performance has got us near the top decile of managers, which I think just highlights how unusual a period we've been in. It's also important to note that our portfolio is much broader than the S&P. So fewer than 10 out of our 40 odd public companies are in the S&P index. We have a lot in mid caps, and we also have over a third of the portfolio in private companies. So there's no perfect benchmark. So we feel the 180% plus return in just under 8 years is a decent outcome, especially given the rough patch that we and other growth investors had immediately after COVID. Recent performance has been much stronger, and we were comfortably ahead of the S&P last year. And then on to page 11, the last one. So you probably won't be able to read the names on this. I'm really sorry. So this shows the holdings in the portfolio categorized by growth theme. So rather than having the names categorized by sector, they're categorized by the long-term structural trends that the companies that are under the same theme are exposed to, like the digital transformation of commerce or digital infrastructure or healthcare, for example. And what I wanted to highlight here is just the breadth of companies that we own. You know, we own companies across a whole range of different areas of innovation and demand. So everyone's been talking about the so-called Mag 7 lately, but we've got to remember that with Mag 7, many of the companies which are in that Mag 7 today, if you go back 10 or 20 years, these companies were mid-caps. You know, 10 years ago, Tesla and NVIDIA, which are Mag 7 companies today, had market caps in the $10 to $30 billion range. So we think many of the big winners of the future will come also from further down the market cap spectrum. And actually, many of those big winners of the future will be in private markets today. And we're particularly excited about companies like SpaceX in space, Stripe in payments, Databricks in AI, Zipline in drone delivery. And all of these companies are private. None are easy to access, but you can gain access to all of them cheaply if you buy USA. That's why the fund exists, and that's why we think it should remain in its current form. And then I just wanted to wrap up by saying sort of three final things. One is thank you to the long-term shareholders who believed in us and who backed us on this journey. We're proud of this vehicle, and we wouldn't have been able to do it without your support. Number two, it's very noisy right now. There's a lot going on. There's a lot of sort of news coming out on a day-to-day basis. I think it's really important we don't lose track of what it is we're all here to do. You know, this fund is ultimately about making lots of money for you, the investors and the savers, over the long term. And you need to make a judgment on whether you're more likely to do that with the strategy I just talked about or with the requisitioner's proposal. And then finally, please, 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 please vote. That was it for me.
Good. I think I'm back. Very good. Right. Thank you, Gary. That's really quite useful as an introduction. We've got a few questions already. Let's start with sort of some bigger picture ones. How big is the team running the fund?
How big is the team?
Yeah.
Yeah, we have 9 investors on our US equity team at Baillie Gifford. So Kirsty Gibson and I are the 2 managers who have accountability for this fund. But we're backed by a wider team who focus on US equities. And then there are tens of additional investors across the Baillie Gifford Investment Department who do work on US companies as part of their role as a global portfolio manager. And we get to draw on that research because we have a single research platform at Baillie Gifford that everyone has access to. And then we also have a dedicated private companies team, which I think has 8 or 9 investors on it as well. So that's been really critical for us in terms of relationship building, private company research, and ongoing monitoring of the private companies that we invest in.
So do they bring ideas to you, or are you going out looking for them?
Well, it's most of the private company ideas are researched by the private companies team, but they can come in from just about anyone in the firm. So when I'm over in the States, I just spent a month in the US towards the end of last year. I try and do that every couple of years, where I'll go over and sort of plug myself into one of these innovation clusters like Silicon Valley or the Boston biotech area and just meet with companies. And I meet with public companies, private companies, academics, sort of industry thought leaders. So, and because, I'm very interested in what's going on, but if we decide to take forward a private company, then it's usually the Baillie Gifford private companies team that does the due diligence, and then we come together to discuss the note, with all of the different pots of money at Baillie Gifford that have got the potential to invest in private companies. So it's a centralized research effort and distributed decision making.
Yeah. Okay. Cool. Can you explain the difference between this fund and Scottish Mortgage?
Yeah. So this fund is smaller and US focused, and Scottish Mortgage is larger and global. I think Scottish Mortgage can invest up to 30% in private companies, and US Growth Trust can invest up to 50% in private companies. So this is a specialist fund focused solely on the US market. Scottish Mortgage is a global fund focused on the whole world.
But will there be a fairly big overlap between the two portfolios, or does it tend to end up being between the two US portfolios?
There's some overlap, but there's differences too. At the end of the day, it's up to Kirsty and myself to take the final decision on private companies that make their way into this portfolio. So there's quite a lot of variation. You tend to see more overlap in more consensus, I guess, and this would be true across the firm, in the larger names in the portfolio, the more established businesses. So, Scottish Mortgage would own a company like SpaceX, like Databricks. But then as you go further down the portfolio, you'll find names that we own that Scottish Mortgage doesn't own, like Fair, Brex, Billion to One, for example.
Fair enough. How does the cash and gearing balance work within the portfolio? Do you use gearing? Do you keep big cash balances sometimes? How does that work?
We don't run with a significant cash balance. We usually have cash sitting somewhere in the region of 0.5% to 1%, and raise cash as necessary. The gearing, we have about $50 million. We think for a long-term orientated strategy, some gearing makes sense. The view of the board, markets tend to go up over time, and our aim is to outperform those markets. So gearing is useful in a long-term fund like this, but we wouldn't ever want to have so much gearing that it would potentially compromise our ability to invest for the long term. What can often happen if you push your gearing too far is that you end up with covenants which would force you to sell positions on drawdowns, and we really, really want to avoid ever getting into a situation where our covenants are forcing us to do things that we don't think are in the best interest of shareholders.
Fair enough, that makes sense. Do you ever look at companies outside the US, or I'm guessing your definition of a US company is something that's domiciled there? Is that right?
It's more, it's more to do with where the company mainly does its business.
Okay.
So is it like genuinely? Does it have the sort of culture of a company that has come out of the US innovation ecosystem, and does it do a majority of its business in the US? Usually domicile headquartered. We're not so focused on where a company happens to be listed. There are a lot of companies which are listed in the US which we just don't think are US companies.
Fair enough, that makes sense. Cool. What's been the main driver of the returns over the life of the fund? And I know actually there is a slide on this if we can get it up in the appendix. But which stocks have actually made a difference to your numbers?
So the returns. If we could pull up the slide, then I can.
What was the attribution slide?
The attribution slide, yeah. We've got the 12 months, and we've got this since inception. Yeah, there we go. That's it. Yeah.
That's it.
So, so you can see the largest. These are relative contributors rather than absolute. So the largest relative contributors and the biggest relative detractors since inception. So in the biggest contributors here, you've got Tesla at the top, Shopify, which is a provider of software for merchants to manage their businesses online. Phenomenal business. SpaceX, which I think increasingly everyone knows, they just had another successful sort of chopstick catch of their booster last night, which was really phenomenal to watch. Trade Desk, which is a demand-side advertising platform, and Amazon, which is obviously a huge company that's involved in cloud computing and online retail. And I think the point I would pull out here is just the breadth. You've got companies addressing the transportation market, Tesla, and electric vehicles. You've got companies providing software for e-commerce, Shopify, companies looking to expand the frontier, SpaceX, communication, Trade Desk and advertising, and then Amazon, there's a bit of retail in there as well, but there's also cloud computing. And I think this breadth of contribution reflects something which I think is quite important to understand, and that's just that we're going through a period of significant change in the global economy right now, and it's not happening on one front, it's happening across multiple fronts. Transportation is being disrupted by electric vehicles. The IT landscape is shifting with corporations moving their workloads from on-premise into the cloud. Shopping is moving from offline to online. The incumbent broadband providers are being increasingly challenged by this global cluster of low Earth orbit satellites that SpaceX has put up, and which is offering high bandwidth, low latency internet anywhere on Earth. So there's lots of change going on. That's creating lots of opportunities, and that's resulted in a broad range of contributors.
When you're looking, the fund's not particularly old yet. How long a sort of period do you envision holding things when you buy them?
Yeah, so this fund isn't that old. It's been up and running since 2018, but we actually have an open-ended vehicle called the Baillie Gifford American Fund, which was launched in 1997. So that has a much longer track record, approaching 30 years now. So we launched the US Growth Trust in 2018 because we wanted to have a vehicle which could do public and private. To your question on time horizon, our turnover is averaged between 10-15%. It sometimes goes up close to 20%. So if you just take the inverse of that, our implied holding period is 5 to 10 years. Mm-hmm. And the average turnover for a US mutual fund is closer to 100% when I last checked the statistics. So I think this is quite an important point. It's sort of, we're operating at a different point in the duration curve. Mm-hmm. So there are just lots of investors out there who are trying to play this sort of quarterly earnings game, where they're trying to come up with a better informed view of what the next quarter's earnings are likely to be, and get in ahead of everyone else, and then get out before the momentum turns. There are so many investors playing that game, hedge funds, mutual funds. It's really, really, I'm sure there's some investors who do it well, but that's not where we play. We play at the long end of the duration curve, where we're looking for exceptional companies and asking the question, how great could this company be, and how big might it be in 5 to 10 years' time? And there are just much fewer investors who are pursuing that approach, which I think is one of the things that gives us a competitive advantage.
So what would actually make you sell something?
Yeah, so one thing that would make us sell is if we can't see a path for sufficient upside in future. So the minimum return threshold that we're looking for a stock in this portfolio is to deliver 2.5 times over 5 years. That is a probability weighted requirement. If you look at the S&P 500 over the long term, approximately 1 in 5 companies goes up at least 2.5 times. And those companies are the ones that drive stock market returns. So we're looking for companies that have got the potential to deliver a 2.5 times return, but where we have a much greater than 20% level of confidence in that outcome. So tipping the odds in our favor towards finding these outliers that drive market returns. If we can't see a path to 2.5 times, then we won't own stock. And we actually have a process in place now where whenever a stock hits the 2.5 times return, from its most recent review, it's automatically re-reviewed. Now, the companies that we own are pretty dynamic, so often even when a company's already gone up 2.5 times, there's still upside to go for. And particularly with what I call these exceptional growth companies, that's where the big returns have come from over the long time. It's the companies that have been able to grow faster for longer at higher rates of return, and they've been able to compound at 20, 30, 40% year after year after year. So we try to exercise patience, but if we can't see that 2.5 times return, we won't own a stock. The other reason we might sell is if we get our analysis wrong, and we do that, from time to time, or if things change. If we overestimated the addressable market, if the competitive position wasn't as strong as we thought it was, if the culture wasn't as strong as we thought it was, then we move on. And the way we monitor that is for every stock we have in the portfolio, we write what we call a forward-looking hypothesis, which is what needs to happen in order for us to make that 2.5 times return qualitatively. And we track the stocks in the portfolio against that forward-looking hypothesis on an ongoing basis to monitor for deviations. And if there has been a deviation, either positive or negative, then we take a serious look at it and make a judgment on whether we need to do something or whether we're content to continue holding.
If I can make an observation, I mean, what you're saying here about trying to make 2.5 times your money just puts into context. So there's a question here about the average discount's 10%, and then today it's 7%. I mean, we're talking about tiny amounts of movements relative to what you're trying to do with the NAV of the share.
Yeah. I mean, the discount, is 7% today. The average discount from IPO has actually been 4.4%. And there were long periods actually where this fund traded on a premium to NAV. I can't promise it'll do that again, but there's no reason why it couldn't do that. But I think the main point is that like a 7% discount isn't all that notable in the context of a 180% plus return in NAV over the last 7 or 8 years. And I think if you got too hung up on the discount with this, you'd have missed out on what the real purpose of this vehicle is, and that's to provide exceptional capital growth for long-term investors. Yeah,
very well made, I think. There's a few questions on individual stocks. So let's talk about some of these. Actually, well, there's one technical thing. So the holding in trade desk is through something called Class A. So can you just explain that when you look at your portfolio, there's sometimes lots of different classes of stock and stuff that you hold. Why is that?
Yeah, so it's an interesting one actually. So a lot of the the question just popped up. So a lot of the founder-run businesses that we own have dual class shares, which where the outside investors will hold a certain class of shares, and then the founder holds a different class of shares. And those founder class shares often have what is called sort of super voting rights. So the ordinary investors might have 1 vote per share, and the founder might have 10 votes per share. Now this doesn't, through a UK corporate governance lens, doesn't sound great. And in an ideal world, you wouldn't want to have these structures, but I actually have a lot of sympathy for them, because what the founders of the businesses that we invest in are trying to do is often very difficult. And these companies often go through very challenging periods on the path to greatness. And so long as we still believe in the ultimate outcome, so long as we still believe in the mission, we want to be able to back these companies through those difficult periods. And we've done that with Tesla, we've done that with Amazon, we've done it with NVIDIA over the years. Trouble is, during those periods of underperformance, what often happens is you'll have activists pop up on the shareholder register, and they'll try and make changes to boost the share price in the short term, which could impair the ability of the company to meet its mission in the long term. And so what these dual class shares do is provide the founders of these businesses with the air cover necessary to fight back against those opportunistic attacks and protect the interests of long-term shareholders. So I have a lot of sympathy for those structures in the right kind of businesses. And I think they've actually been, if you were to ask me what are some of the reasons why the US market has done better than the UK, I actually think this is one of the reasons. The US has allowed US companies to put in place measures which have enabled its businesses to be run genuinely for the long term and to avoid these really sad scenarios where you end up with something happening like, a founder being kicked out at the worst possible point.
Yeah, fair enough. That makes sense and quite sort of opposite. What was the attraction of Shopify?
What was or what is?
Yeah, what was?
So what we're looking for are exceptional growth companies. And what we mean by exceptional growth companies are companies that have the potential to grow faster for longer at higher rates of return. And the reason these companies are so valuable is because the market normally assumes, and most analyst models will do this, that the current year growth rate is the fastest a company will ever grow, and that its growth rate will decline over time to a terminal value. And most companies do that, so it's a good approximation, but rare exceptional growth companies don't do that. They grow faster for longer, and they manage to sustain supernormal rates of growth year after year after year. Now, question, well, what is it that enables companies to do that? What are the ingredients of exceptional growth companies? And there are three things that we look for as signals of that. One is companies address a large market opportunity relative to their size, which gives them the ability to grow unimpeded for long periods of time. Second is that they have the ability to build a strong and sustainable competitive advantage in time, because growth is only valuable if it's profitable. And then the third one, which is maybe the most important one, is that these exceptional growth companies often have strong, distinctive cultures. They don't behave like the average company. Their businesses are run for the long term. They're willing to invest. They're willing to embrace risk. They're often founder run, run by people who have an attachment to the business rather than the share price and who are trying to build something meaningful. So the reason we invested in Shopify is because it addresses a large market opportunity in the form of e-commerce, because it has what we believe is a very strong and reinforcing competitive advantage. It's a software platform, and the bigger it gets, the stronger it gets. And then thirdly, it is a founder-run business, and the founder of Shopify, Toby Lipka, is one of the most thoughtful and long-term orientated managers I've ever come across. He says he's looking to build a company that lasts 100 years with Shopify, and I believe him, and he manages the business in line with that.
Thank you. That's good. PsiQuantum, can you talk a bit about that? Because apparently the valuation has been written up recently.
Yeah, so PsiQuantum, this is one of the smaller private companies in the portfolio. Quantum computing is an area which is still at a relatively early stage, but it's one of these areas where if the technology can be made to work, the upside potential from owning a stock that's the leading edge of that sector could be absolutely massive. We've been monitoring this space for a very long time. Luke Ward, who did the due diligence on SpaceX for Baillie Gifford, also diligenced the quantum computing sector for us. And PsiQuantum was the company that we identified as being the most interesting and attractive asset. They are a lot further ahead than people would probably assume in terms of developing this technology. They're going about it in a very different way, using photons, which enables them to access a lot of hardware that's been built for the semiconductor industry, so they're not starting from scratch. And they've also had significant backing from both the Australian government and the US local and federal governments, I think DARPA as well. So we think that this is one of the sort of premium assets in what is still an early and fragmented space.
We should probably talk about the new president in the States. So to what extent do you think the new government's going to have an effect on the portfolio and maybe some of the holdings that you've got?
Everyone loves to talk about Trump, but I'm not sure how important the president actually is for what we do. Like, I think, if you're investing in economically sensitive businesses and that's the primary driver of growth, then who is in the White House matters a lot. But I suspect, and you could challenge me on this if you feel differently, like that, if we were to rewind 20 years, 25 years, and literally flip who was in the White House during the different presidential cycles, from who was there to who lost. I don't think it would have made that much difference to Amazon or Nvidia or Tesla, because what's driven the outcomes there has been the scale of the opportunities that these companies have been addressing and their ability to execute against those opportunities. Now, there's obviously a lot of noise in the market right now about what a Trump presidency might mean. There's talk of inflation, the long end of the bond curve has been going up. I think even on that sort of stuff, it's really, really hard to predict. On the one hand, there's talk of tariffs, and that would be inflationary. But on the other hand, he's talking about putting in place this Department of Government Efficiency, which would, Elon Musk has said might take as much as $2 trillion out of the budget. I think that would be very hard to do, but that's a very deflationary measure. And then you have AI, which is a very deflationary force. And so I don't think that side of it's clear. If I was to spin this positively, what I would say is you look at the people that Trump's putting in place around him. There's a lot of experienced business people, a lot of venture capitalists, a lot of people who understand technology. And so there's a chance that, one of the potential positive outcomes from this for investors is that these people manage to remove a lot of the red tape that's been holding back innovation in certain sectors in the US and actually drive growth. I think it's really interesting, because there's been a lot of regulation in the US, and people will argue that this regulation has held back the US in areas like drone technology, batteries, robotics, etc. But you look at how the US has performed. So in a way, the US has done what it's done with its hands tied behind its back. And if we could unshackle that, then the next 10 years could be even more positive for the US than the previous has been. But we'll see. I'm not a macroeconomist. So.
Fair enough. One of the things that they're saying that the shackles will come off and will do well is financials. Is that a sector that you'd look at?
We own financial technology companies in this portfolio. And companies which are leveraging technology to try and improve the financial system. So we have, in the public market, we've got a company called Affirm, which is a buy now, pay later company, which we actually invested in when it was private. So it's run by Max Levchin, who was one of the founders of PayPal. And he's a phenomenal talent. We invest in a company called Block, which has two main businesses underneath that heading. It's Jack Dorsey's financial services company. There's Square, which does software for offline merchants mainly, and then there's Cash App, which is a peer-to-peer payment network in the US. And then in the private sphere, we own a company called Stripe, which is a platform that allows merchants to move money around the world seamlessly, which was a surprisingly difficult thing to do until Stripe came along. That's a wonderful business. It's got a very high share of startups, and it's almost a sort of royalty on the innovation economy. So we do have companies in the financial sector, but the investment cases for each of them is sort of bottom-up driven. And we've looked at them through our framework of market opportunity and whether they're trying to do something different, potential to build an edge, and culture.
And then, since the biggest holding, we should probably speak a bit more about SpaceX. So, obviously, it's not sort of one way. The launch, the capture happened, but the launch blew up, didn't it?
Yeah.
So, but I guess these things are insured.
What
do you see is the sort of potential, the final potential for that?
Right. So what Musk has done with SpaceX is remarkable, really remarkable. Until SpaceX came along, it was really uneconomical to put things into orbit. And the reason for that was rockets weren't reusable. So the analogy would be, imagine if you were flying from London to New York and they scrapped the plane at the end of the flight, how much your ticket would cost. That's where the space industry was before SpaceX. What SpaceX has done is it's made rockets reusable. So it's sending rockets up and bringing them back. And it's doing that routinely now, almost every day, right, with its original Falcon 9 rocket. And so that reusability has brought down the cost of putting mass into orbit, and it's opened up new applications and new use cases. And actually, most of the value in SpaceX today comes not from the rocket launches themselves, but from what those rocket launches have enabled SpaceX to do, which is a business service, which is a business called Starlink. So what Starlink is, it's a constellation of thousands of low Earth orbit satellites that are delivering high-speed internet anywhere on Earth. Now, most of us are pretty lucky. We live in big cities. We have access to fast broadband, but there's so much of the population, even in the US, that doesn't have access to that. And there are many situations where you still don't have access to fast broadband, like if you're on a plane or if you're on a ship or if you're in a cottage in the middle of nowhere, right? So Starlink is addressing this opportunity, and this is a massive market. This is one of the biggest market opportunities globally. And there's no one else that's even close to SpaceX in this right now. In fact, there's no one else that's even close to SpaceX in launch. I think last year, SpaceX was responsible for putting about 90% of all of the mass into orbit that went into orbit, and that includes nation states like China and Russia. So with regards to Starship, the one you saw, like they brought down the booster and caught it with chopsticks. The primary stage broke up on the way back down, which so one of the reasons why SpaceX has been so successful is that they're willing to innovate in public. And one of the problems with the government programs has been that they've not been willing to put a rocket up until they're 100% sure that it's going to work. But to get to 100% certainty, requires a lot of time and a lot of money. And also you can never be sure because you've not tested it. So what SpaceX does is it throws something together, launches it into the air, blows it up, learns, does it again, does it again, does it again. And by doing this it's the classic sort of lean startup where you launch, you learn, you iterate, you improve, you launch, you learn, you iterate, and you improve. You're doing that with Starship. What Starship is going to do in the short run is make those satellite launches for Starlink even more economical because it's a much bigger ship. Over the long term, what Musk hopes it will do is enable us to build a self-sustaining human colony on Mars. But that's probably a way out yet.
Yeah. And the fun will be enormous by then.
Yeah.
If it's allowed to survive. So please do go out and vote, everybody. Thank you very much for your time, Gary. We should put up the disclaimer slides to make sure we tick all the boxes. But thank you very much for your time today, and good luck with the vote. And we'll get you back on again, hopefully in a year's time or so, and see how it all went. But good luck.
That'd be great. Thank you, James.
So thank you everybody for tuning in today. Sorry for the sort of technical stuff again, and we'll try and get that fixed next time. And have a good weekend, and we'll see you next Friday.